You walk into a showroom, brand new phone, sitting right there under those perfect LED lights. It's gorgeous, it's fast, it's basically everything your current phone isn't. And then the salesperson leans over and says those 6 words that have destroyed more financial plans than anything else in history. You can take it home today. No full payment required, just 12 easy monthly installments, $3,500 a month. That's it. That's less than what you spend on coffee. And you think, okay, that's actually not bad. I can do that. So you sign the form. You walk out with the phone, you feel great, and then you come back next month for a laptop. Same deal, easy installments. And then a washing machine breaks down, so you put that on EMI too. And before you know it, you've got 5 different EMIs running at the same time, and every single month before you've even eaten breakfast on the first of the month, $18,000 has already left your account. Not invested, not saved, gone. Committed before you even woke up. That's where we're starting today. My name is Smith, and I spend way too much time thinking about how ordinary financial products are quietly engineered to keep ordinary people from becoming wealthy. If you're someone who has ever looked at your bank account at the end of the month and wondered where it all went despite having a decent income, hit subscribe and give this video a thumbs up, because what I'm about to show you is going to change how you see every EMI offer for the rest of your life. Now look, I want to be clear about something before we go any further, because I know exactly what some of you are thinking right now. You're thinking, Smith, EMIs are just a tool. They're neutral. It's all about how you use them. And I hear you. I really do. But here's the thing. That argument sounds smart, and it's completely wrong in practice for most people. Not because EMIs are evil, but because the psychology around them is so deeply stacked against the average consumer that using them wisely is almost a statistical impossibility if you haven't been trained to think a very specific way about money. And rich people, people who have actually built real compounding generational wealth, they understand this, which is why almost universally they avoid EMIs in a way that most of us were never taught to. Let's get into it. Here's what most people don't realize about how EMIs work at a psychological level before we even get to the math. When you buy something in full, you feel the pain of that purchase completely. Psychologists call this the pain of paying, and it's one of the most powerful natural brakes on human spending behavior. When you hand over $42,000 for a phone in one shot, your brain registers that transaction. It feels expensive. You think twice. You might even walk away. But when you split that same purchase into 12 payments of $3,500, your brain doesn't register $42,000. It registers $3,500. And $3,500 doesn't feel like a big decision. It feels manageable. It feels responsible even. You've budgeted for it. So you buy the phone and the laptop and the furniture set. And every single time, your brain is processing the small number. Not the total cost, not the real cost, not the cost with interest, not the opportunity cost, just a small, comfortable monthly number. This is not an accident. This is a design feature. A study by professors at MIT and Carnegie Mellon found that payment method dramatically changes how much emotional resistance people feel towards purchases. And installment-based pricing is specifically engineered to minimize that resistance. The financial industry has known this for decades. The showroom knows it. The bank knows it. And now, so do you. Okay, so let's talk about the actual math, because this is where it gets interesting and honestly a little uncomfortable. Let's use a completely realistic example. Let's say you're a 28-year-old with a take-home salary of $75,000 a month. You're doing okay. Not great, but okay. And over the last 2 years, you've taken on what feels like pretty reasonable EMIs. A phone upgrade, $3,200 a month, a new bike, $6,500 a month, a small home appliance loan, $2,800 a month, maybe a personal loan for a vacation or a wedding, $7,500 a month. Nothing crazy, right? Each one made sense at the time. Added up, that's $20,000 a month, every month. Gone before you do anything else. That's 26.6% of your take-home income committed to past purchases, things you already own and are still paying for. Now, here's the question no one asks. What is that $20,000 actually costing you? Because if you had invested that $20,000 every month into an index fund from age 28 with a modest average return of 12% annually, which is well within the historical range of broad Indian equity indices, by the time you're 50, that money would have grown to approximately 2.6 crore rupees, 2 crore 60 lakh rupees, from just $20,000 a month over 22 years. But instead, that money is going backward. It's paying interest. It's paying for things that are depreciating. A phone that'll be outdated in 2 years. A bike that's losing value every day. You are not just losing the $20,000. You're losing what that $20,000 could have been. And that gap between what you spent and what it would have been worth, that is the real price of your EMIs. Economists call this opportunity cost. I call it the invisible tax on people who were never taught to think about money this way. Now, you might be thinking, okay, Smith, but what about home loans? Surely those are different. Even rich people take home loans. And you're right, sort of. And we need to address this directly because this is the most common objection I get whenever I talk about this topic, and it's worth giving it a proper answer. There is a meaningful difference between debt that acquires an appreciating asset and debt that finances a depreciating one. A home, in many markets, tends to appreciate over time. A phone, a car, a holiday, a flat-screen TV, these all depreciate. They lose value the moment you take ownership. Financing a depreciating asset with interest-bearing debt is almost always a wealth-destroying decision. You are paying a premium, sometimes 18 to 24% annually in real effective interest rates, for the privilege of owning something that is simultaneously losing its value. But even here's the thing. Truly wealthy people are extremely calculated about real estate debt too. They don't just walk in and take a home loan because the EMI seems affordable. They run the numbers. They compare the effective cost of borrowing against the expected appreciation of the asset. They think about liquidity. They consider what that down payment money could have done in the market instead. They make deliberate decisions. They don't react. They don't get sold. That discipline, not the income level, is what separates them. Let me tell you a story. There are two cousins, same family, same upbringing, both got jobs in the same year at similar salaries. Let's call them Arjun and Karan. At 25, Karan gets a salary bump and immediately upgrades his lifestyle. New phone on EMI, car on loan, apartment upgrade means higher rent, so he takes a small personal loan to cover the security deposit. Over the next 5 years, he manages his money reasonably well. He's not irresponsible, he's not reckless, he's just doing what most people do. His EMIs float between $15,000 and $25,000 a month, depending on the year. He lives comfortably, he looks successful. Arjun, on the other hand, makes a different decision at 25. He reads something, maybe watches a video that makes him think differently. He decides that every time he wants to buy something on EMI, he's going to ask himself one question first. Can I pay for this in full? If the answer is no, he doesn't buy it yet. He saves. He waits. And while he's waiting, he invests the money he would have spent on EMIs. He drives his old bike for 2 extra years. He keeps his old phone until it literally stops working. He's not flashy, but he's building. By 35, Karan has a decent lifestyle and almost no savings. He's thinking about starting to invest seriously now. By 35, Arjun has a portfolio that's generating passive returns. He's starting to feel the compounding kick in. By 45, the gap between them is not just financial, it's philosophical. Karan is still trading time for money, still dependent on his salary, still a month or two away from financial stress if something goes wrong. Arjun has options. He could take a lower-paying job he loves. He could take 6 months off. He could start a business and absorb the risk. He has what most people spend their whole lives wanting: freedom. The only real difference between them was the $15,000 a month and what each of them decided to do with it. Now let's talk about something even more insidious than the math, and that's the identity trap. Here's what most people don't realize. Over time, your EMIs don't just drain your money, they shape your self-concept. When you are consistently buying things before you can afford them, you are training your brain to associate the feeling of ownership with the process of borrowing. And that is a deeply dangerous association to normalize. Because when you go from a $3,500 EMI to a $35,000 car EMI, it doesn't feel proportionately more dangerous. It feels like the same kind of decision, just a little bigger. The framing is identical. The psychological comfort is identical. And so the spending scales up with the income and the cycle continues. And we get to that phenomenon that most financial educators talk about, but very few actually explain: lifestyle inflation. Lifestyle inflation is not just about spending more as you earn more. It's about permanently committing more of your future income before you ever receive it. Every time you take an EMI, you are selling a portion of your future freedom for a present-day convenience or status symbol. And because each individual EMI feels manageable, you never really confront the aggregate. You never sit down and look at the full picture, at the total amount committed, the total interest being paid, the total opportunity cost, because that number would be too uncomfortable to look at. Rich people look at that number. That's part of what makes them rich. This is where it gets interesting, and this is the part I don't think gets talked about enough. Wealthy people don't just avoid EMIs because they can afford to pay cash. Many of them could absolutely take EMIs. Some of them even have access to credit at much lower interest rates than you or I do, but they've internalized a completely different rule about money, which is this. The goal is not to maximize what you can afford to spend. The goal is to maximize the gap between what you earn and what you commit. That gap between income and committed expenses is called financial slack. And financial slack is the raw material of wealth. It's the space where investment happens, where opportunity can be seized, where risk can be absorbed, where freedom is built. Every EMI you take is a direct reduction in your financial slack. And when your slack goes to zero, when your monthly commitments eat up everything you make, you are one medical emergency, one job loss, one unexpected expense away from real crisis. According to a report by the Reserve Bank of India and various household finance surveys, a significant portion of middle-class Indian households have a debt-to-income ratio that leaves less than 10% of monthly income truly discretionary. Less than 10%. That's not financial planning. That's financial survival. And it's almost entirely a product of normalized, accepted, and celebrated EMI culture. Now, you might be thinking, okay, Smith, I get it, but I already have EMIs. I'm already in this situation. What do I actually do? And I want to spend a real amount of time on this because theory without action is just self-pity with better vocabulary. First thing you do is get completely honest with your current position. Sit down, not in your head, on paper or a spreadsheet, and list every single EMI you're currently paying. The amount, the remaining tenure, the interest rate if you know it, and the total remaining amount to be paid. Don't skip anything. Don't round down. Face it completely. Then calculate your total monthly committed outflow, EMIs plus fixed expenses like rent, and express it as a percentage of your take-home income. If it's over 50%, you are in the danger zone and you need to treat this like an emergency. If it's between 30 and 40%, you're in the caution zone. Manageable but needs active intervention. If it's below 30%, you're in decent shape and can now think about optimizing rather than firefighting. Second, create a priority order for elimination. High-interest consumer debt first. Personal loans, credit card balances converted to EMIs, anything over 15% effective annual rate. These are genuinely wealth-destroying, and they should be eliminated as aggressively as possible. Every rupee you put toward a 24% interest loan is giving you a guaranteed 24% return, which is better than almost anything else you can do with that money. Third, and this is the behavioral shift that makes the previous two steps sustainable, change your purchasing rule going forward. This is the rule I encourage you to adopt. Before any purchase above $5,000, ask yourself whether you could pay for it in full right now. If the answer is no, the decision is simple. You save for it first. You don't buy it yet. This doesn't mean you never buy nice things. It means you buy them on your schedule, not the bank's. This one rule, applied consistently, will change your financial life more than any investment strategy I could ever tell you about. Let me give you a real number to think about as we come toward the end of this. The average Indian middle-class household pays somewhere between $2,500 and $15,000 per year in pure interest, money that buys them absolutely nothing, money that is just the price of not waiting. Over a 30-year working career, even at the conservative end, that's $75,000 to $4.5 lakh in interest payments. But remember the opportunity cost layer on top of that, because that money invested instead would have grown into something meaningful. In many cases, we're talking about the difference between retiring comfortably and retiring dependent. That's the real cost, not the EMI. The EMI is just the mechanism. The real cost is the life you don't get to build because that money was already spent before it arrived. Here's the thing about rich people and their relationship with money. It's not actually about being greedy or miserly or deprivation. The ones I've studied, the ones whose financial philosophies I find genuinely worth emulating, they spend money, sometimes a lot of it, but they spend it intentionally on things that align with their values, for things they've decided in advance are worth it, and they pay for those things without borrowing from their future selves to fund their present image. That distinction, intentional spending versus reactive spending, is, I genuinely believe, the most underrated wealth building habit in existence. More than any specific investment, more than any tax optimization strategy, more than any side hustle, the ability to delay gratification, to look at an EMI offer and feel no pull toward it, to be completely unbothered by the gap between what you could buy and what you choose to buy. That is a superpower, and it can be learned. You don't need to be born wealthy to think like this. You need to decide to think like this, and then you need to practice it month after month until it becomes automatic, until the $3,500 EMI for the new phone genuinely feels like what it is. Not a deal, not a convenience, but a commitment of your future freedom in exchange for a present-day status signal that will be outdated in 18 months. I want to leave you with one final thought. Every EMI you don't take is not a sacrifice. It is a deposit into your